All right. Good morning, everybody. A little bit of a mixed bag this morning. NASDAQ down 1%, small caps right behind it. S&P down 0.75%. And then Dow down just a little more than a half. Netflix, one of the biggest tech names, getting whacked on some proposed media tariffs. We have PMI and ISM services today. The numbers really aren't that far out. So I would never suggest that we ignore an economic event or that it's not worth watching, but not expecting a lot of fireworks from either one of these. Never know though, right? We don't want to discount the idea that the market can suddenly decide it wants to pay attention to it this morning and jump on a reason why. So that does fit in with the pullback that we were talking about last week, how we need to make a higher low on the daily. So we've started this move. We need to pull back. If you measure this last leg and you set it over here, it comes in above this gap, somewhere around this 5,400 area. And really, it just looks like a deeper pullback than we're likely going to get. All right. But if we are going to continue this and we do get a higher low, then we need to pull back 5,500, 55 and a quarter, perhaps, bounce on that 20 period moving average. That wouldn't be out of line. But a pullback is expected at some point. Either we get it today or we get it this week. Got FOMC later on. So holding inside of Friday's range would make the most sense since it's a really big bar and it set a new high on that breakout. On our ways back up, and it would just define a really classic range. So baseline bet is we hold the line here until FOMC. Of course, we can wick lower, but the idea would be that even if we do wick out, we would come back in and close by the end of the day. We're only talking 2.5 days, right? So it's not forever. Nice, easy number, 5,600 on the downside. We are a long ways from the put wall. And we're getting closer to that 5,800 call wall. So I want to keep our eyes on that put wall, see if they roll it up. It'll act a bit like structure if they do. It'll also be considered a little bullish. We want to see the call wall also rolled up, get it out of our way. It's surprising to see it so close to us as we get close to FOMC. So really want to keep your eye on that over the next few days and let that be a little bit of guidance for you where they go with the call wall. If they don't move it at all, or if they do end up rolling it higher, somewhere around 5,875 or 5,900, kind of get the idea. The light volume continues. Last week we were able to say, well, Japan was gone. There were a couple other nations that were out, and it was a big holiday week. But here we are in a new week, and we're still looking at pretty light volume, all things considered, compared to what we've seen, in the last 6 to 8 weeks. This is really light. It does feed into the idea that FOMC is a really big deal and the markets are waiting on it, and it could feed into the idea that we go sideways into FOMC. just keep in mind, markets make really big moves on light volume, or they can, because it doesn't take as much to move a market when there's low volume. We are closer to the lower ADR than we are the upper. And the lower is within yesterday's range, so we wouldn't even need an inside day breakout to get there. It's close, but we could stay in the line and still hit the lower ADR. The idea would be that if we get the ADR, we're likely going to stall out there. Maybe wick a little lower, come back in, because that is that 5,600 line in the sand we were just talking about a few minutes ago. It's more likely, if we don't want to see the market make the average daily range, kind of consider how we got that, right? We got that really big number because the market was making really exaggerated moves, big moves on a day-to-day basis. And those big move days add up, and then that becomes our norm, right? And we say, oh, the average is much bigger on a daily basis. Well, it needs to shrink up at some point. We got to stop making those really big moves so that the ADR contracts again. If we kind of keep that in mind, then we could focus on something like yesterday's RTH low, which, we already tested that in the Globex. We finally broke it. We're underneath it now, but we got another area here. So we could see if this area that may have a footprint to it, if we was to put on TPO or a volume profile, we could see what structure this left behind. But 5650-ish, same spot really, would be a good place to find some support. If not 5650, then 5632 cog line, which would be this low here plus a little, right? Which would imply we don't even have enough juice to make an average daily move, because the days are getting smaller again, and that we won't make it to the ADR half at all. $56.30 is the week's floor pivot. We're just inside that channel, and it's a really wide channel. Not as wide as we had last week, but still significant. It's wide enough. A wide channel implies that even if we do break out, it doesn't stick, but that's a weekly level. So we're talking about a breakout on a weekly time frame. We'd look at a weekly candle and consider where last week's low is, and the idea that it would be a big move just to get to the bottom of last week's low, and then we would need to break out from that and go even lower. And this is saying if we did that, we'd likely come back in again. Or if we break last week's high, which is a lot closer if we look at the upside, that even if we did break out of that, we would likely come back in again. Just keep in mind, it's talking about the whole week, and that these channels don't make price do anything. The daily pivot is higher than yesterday's pivot. That's bullish. We opened above it with price. That's also bullish, but we've cut through it. We're underneath it. We've tested it from below, and we've expanded outside of the pivot channel. So it's not bullish at all. At the bare minimum, we would expect to get back to that floor pivot. Take a lot of work to get back above it. At this point, we would need some sort of news or catalyst that could even get us back inside that channel, let alone get us back to the floor pivot. S1 is just above the weekly pivot. So if we do continue this fade to the downside, that weekly pivot lines up 5632 cog line. It's that low that we were talking about a few moments ago. It lines up with S1. It's becoming more and more clear that if we do continue this drop to the downside, 5630's got a lot of structure, a lot of support. It's a very likely that we're going to turn around there and move back up unless some headline comes in, some shocking all news that we can't see at this point. That would be my reversal for the day. If we get that low, right? We don't even have to get there. $55.50 last week's point of control. Lots of structure here. Got a shallow area to move through down into 56, where we left that footprint last week. And we got some structure around this 56.50 area, which is pretty much what we're coming in to test this morning. Value area high of last week. This isn't a classic shape. It's just high elevation levels. So one by one, we break them out, fail, go to the next one, fail. If that doesn't hold, we break down, go to the next one, level by level. We're really not looking to get below that 5,600 though, so kind of need that to be our guiding light at the moment. Ten-day volume profile with TPO kind of holding against the upper level here. Like we discussed last week, we're not expecting to see this point of control move anytime soon. It's absolutely possible for it to do that, but we'd have to build out a lot of volume at one particular spot. So far, there's no reason to believe that we're going to hold the line in one spot enough to build out the volume. And two, that even if we did on a low volume week like this, if we did stay in one spot, there's no saying that we'll build out enough anyways to match this profile and see the point of control move. We won't even get to these candles for most of the week. So, to eliminate the volume that created this point of control, we've got days still to go, and it's not going to get hit during any of that time. So we have to build out a new spot, and that would require us to sit tight, stay above 56.50 and stay below 57.32 cog line. What, an 80-point range? 125-point range. Yeah, we can do that on a light week. The TPO is looking a lot better than the volume profile on that 10-day. So we broke that April 2nd BPOC on Friday. It did a good job when we ran up and tested it, had a nice reaction from it. It just couldn't hold. Eventually it failed. We don't need it, get rid of it. But we did build a new VPOC on Friday. And so if we attempt to make a move to the upside this week, we've got to get through this level. $57.13. That's basically 57.11 cog line. Close enough. The textbooks would tell you to carry forward the value area low and the value area high and the point of control. I only carry forward the point of control because it's untouched right now. But if we do make a move to the upside this morning, we're going to come through that value area low. If you're looking for another pivot, it wouldn't hurt to put it on there. 88 used to be a cog line way back in the day when we had like 28.88 and 32.88, right? When when the ES was at 32.88, been a little while, but 88 used to be a cog line, and over time it just slowly got phased out. But it's a value area low on a old cog line. Has a little footprint to it. Wouldn't hurt to keep your eye on it. If we do attempt to make a break to the upside, just be wary of that 88 level this morning. Could be a rejection that you weren't expecting. You know, it doesn't seem that long ago that we were at 32 and 28. We're still above the 10-week, drifting back towards it, which makes sense because as long as we're just sitting here, the 10's going to move closer and closer to us anyways. All we have to do is hold the line and really not go anywhere, and the 10 will come to us. It's healthy. It's a digestion, gives the market time to find its footing, and it's a way to perform a correction without really going anywhere. So we're holding the line. We're getting a little close. If we get too close to the 10, it'll just kind of draw us in like gravity, makes it harder to get away from it. And what we found is that we can sit and chop in this, like 0.75% up and down at range about 1.5% in total. We can stay in that choppy zone for a couple of weeks. Unless headlines can kick us out of it, get us moving again. In the current environment, headlines aren't really a problem, right? There'll be something that kicks us out of that range. But if this was normal markets and boring times and we had got this close to the 10, it would be a completely different thing, likely to draw us in and get stuck there. As for the 10-day, we're still well above it. We've put in quite a lot of work up here. If you go back and look, there's been periods of time where we spent this much time elevated as high as we were, above that 1.5. A lot of those times we're in a bear market, right? So generally, we get this far away, we pull back relatively quickly. Healthy, it's good, get that pullback. But we didn't do that. We just held it and kept that distance from the 10. Shows a lot of push just to keep us that far away from it. But in bear markets, bullish exuberance has been, record breaking. Some of the biggest up moves in history happened during a bear market. So not a surprise that we've had a consistent, persistent push to the upside, and we've been able to maintain this distance above the 10-day, but all good things have to come to an end at some point. We need to pull back. At some point we will. We set in the high. We've drifted back from that. We're under the 2 now. Let's get under the 1 next. And this isn't about being bearish or bullish at this point. It's just about having a healthy market. We need to get back below that 1. All we have to do is sit tight. The 10 will come to us. So I'm not even calling for, a big breakdown in the market or anything like that. Just hold tight. Go sideways for 2 days for FOMC. And in those 2 days, the 10 will come to us. We looked at last week, the new week, and the range at the time was pretty close to the range we had last week, right? So the expectation was that this new week wasn't looking to hold any more surprises than last week did. And this isn't perfect, right? I didn't get out the calculator and get this down to the very specific tick, but I drew a box on the old week, set that box on the new week, and you can see that the new week is just a little smaller in range than last week. Now, this range is derived by volatility and time. Well, last week had 5 days. This week has 5 days. So time is the same. The only other difference then is the volatility of this week is less than the volatility of last week. Now think about that. We got FOMC this week, and the volatility is smaller. And that is because volatility is suppressed for FOMC. Volatility is suppressed for a lot of economic events. They are volatility suppressing events. So even the market is expecting a sideways day Monday and Tuesday into that FOMC. It doesn't mean we're going to get it. Just, kind of keep that in mind, right? It doesn't owe us a sideways Monday and Tuesday. And there's plenty of FOMC weeks where we did not go sideways Monday and Tuesday. We actually took off and ran for 2 days, and then we stalled and went sideways into Wednesday afternoon, and then we got FOMC and we moved again. But the smaller range does imply the market is also expecting a sleepy Monday and Tuesday with not a lot of excitement. If you look at things that are up this morning, there's not a whole lot to look at. We got precious metals, or at least miners. Let's say it that way, because we really don't have precious metals. We just got the miners. Nat gas and a little bit of China, the emerging markets, which is odd because if we have that one, we should have the others, and we don't. But emerging markets is nearly almost exclusively China. So while there are some others in there, normally they on their own they wouldn't be enough to move it unless they had China behind them. A little odd. Keep your eye on that one. Wouldn't even hurt to open it up, look at the basket of stocks that make up the emerging markets, and see what's in there that's moving that thing around. Looking at everything else this morning, things that are down starts with banks, growth, consumer discretionary, which is our Mag 7 group, financials, technology, communications, energy, just about everything else that isn't sideways is down. And for the things that are sideways, that's a pretty small list, all things considered. Healthcare and airlines, some retail, real estate, biotech. So we don't have anything today. We don't have no catalyst, no sectors that we would look to expect move the market, right? Our risk on sectors, we don't have them. Our risk on names that we generally need to have, we don't have those. No expectation of a breakout or a breakdown with what we've got moving so far in the pre-market. For that to change, it has to be, we get the Mag 7 group, we get 0-day options flow in the S&P and NASDAQ group. We see a significant change to dollar bond yield treasuries. We need one of those to be our catalyst. Right now, we own none of those. Not only do we not have them, but our risk on sectors are down more than 0.5%. So if they are steering the ship, they're pointing us to the south. Chips down more than 0.75%. XLF, XLK down 1%. The China group 1%. Bitcoin 3% to the downside. So yeah, we're not going to get any rally in the S&P unless that changes. And as for breaking out, if we're already that negative and we haven't broke out yet, then what's the catalyst that's going to take us lower? It's not going to be the Mag 7, because if it coulda, it woulda at this point. Keep your eye on those to see if it gets worse. But they're already down a heavy amount, and we're matching them. We're just not getting worse. See the dollar hold around that 4.3 area. No fast moves. but if it holds the line here and doesn't begin working its way back down, there's no reason to expect that we don't move anywhere in ES. So sideways in a 10-year, sideways for us. The dollar back below 100. And again, no big moves. As long as it's not freaking out, then it'd just be the expectation of a sideways day. Nothing making any big moves. We don't do anything drastic, and we all just hold the line. If we start getting fast moves in any of these, then we're likely to start picking up speed in the ES and the NASDAQ. Simple enough. All right, everybody, pretty easy day. I'm going to be out most of the morning session. My wife's got a doctor's appointment, and I got to go with her. So be careful, be safe. You can always ask questions, throw them in a chat. Just be mindful if I don't get back to you right away. You know why. I'll see you all tomorrow.